It's easy to think the cut by US Federal Reserve is always a great news for India. But the story is much more nuanced. It travels through our balance of payments, affects the rupees, changes oil bills, and keeps the RBI busy managing liquidity and reserves. Hello everyone, welcome to Vajiram and Ravi's Flash News. My name is Shubhangi Singh, and today when we are going to understand the Fed's rate cut, we are also going to look into the layers that how it not just boosts mobility but it also has an effect on our external sector and across the globe in multiple ways. So let us begin with understanding this move by US Federal Reserve in which a rate cut has been made, and the rate cut has been of 25 basis points. Can you tell me in the comments section that what do we mean by basis points, or you can also explain that what is 25 basis points equivalent to in terms of percentage. So when we are talking about this rate cut, it basically means that the Federal Reserve, which is the central bank of US, has reduced the benchmark lending rate. That means the borrowing will become cheaper. Now borrowing is easier. That means it will be easily passed on to in a form where loans for households and firms which will be easily available at a cheaper cost. यहाँ पे जैसे RBI फंक्शन करता है, सिमिलर वे में US फेड रिजर्व ने लेंडिंग रेट जो है एक तरीके से आप समझिए वो कम कर दिया है, जिसकी वजह से बोरोइंग कॉस्ट जो है वो बैंक का कम होगा और वही पास ऑन होगा हाउसहोल्ड्स और फर्म्स के लिए भी. और ऑब्जेक्टिव जो है यहाँ पे बहुत सिंपल है. द ऑब्जेक्टिव इज वेरी स्ट्रेट फॉरवर्ड एंड क्लियर बिकॉज द फेड रिजर्व हैज अ डुअल मैंडेट वेयर इट हैज टू मैनेज टू थिंग्स, दैट इट हैज टू सपोर्ट ग्रोथ and employment while keeping the prices stable. But the reason we are talking about this rate cut that has been done in US, because such policies, they affect the globe where US, one of the major economies, US dollar being one of the primary reserve currency, it has a full throttle impact across the globe itself. So when we look at this particular graph, you will find that this dip that has been seen, that was marked in 2025 itself, this is not the first rate cut. The second has just come in September, where the range of 4.25 to 4.5% has been reduced to 4 to 4.25%. And Fed Reserve has also hinted that in coming times there will be possibly more cuts in this very financial year. So the whole idea is to make sure that inflation stays in control, where you can see that inflation is still above the midpoint target rate, and also make sure that the availability of funds is able to help growth. But this move does not only facilitate US, it makes a trickle down effect in the global economy. So when we are talking about effect on the global economy, we have seen historically that last rate cut, major rate cut in 2019 cycle, 3 cuts of 75 basis points, and there was a positive reaction which was seen not just in S&P 500, which is a particular example. You can also see it that Asia market and European market reacted very positively to it. So definitely there is certain linkage that we need to understand. So let us move ahead and talk about that linkage, that how does the Fed Reserve and their rate cuts affects the global economy. So when we are talking about the impact, you have to understand that what exactly is happening. So if we are talking about the rate cut, that means the lending in US becomes cheaper, right? If lending becomes cheaper, then the returns that will be seen in the US's economy, be it on treasury bond, they will also decrease. Correct? Once they have decreased, this directly leads to people would like to invest where they are getting more returns. So they will not focus on US, they will go to other economies which will show better investment results as compared to US, and that will lead to capital outflows out of US, and it will also weaken dollar, which both of them are very much interlinked. If capital is moving out of one country, it will be invested in another country. That will facilitate that increased global equities, increased global risk. There will be more risk appetite in investors to invest in other economies, which will directly help other countries' currencies to become stronger, be it euro, be it yen, be it rupee, and it will also give a global liquidity boost which will be seen. So in this classic scenario, it has been seen that US Fed Reserve rate cut leads to a rise in the risk appetite, and it also gets positive reaction, especially from developing economies like India. Now that we have understood the basic theoretical effect that we get to see, now let us move to a clearer understanding that what will happen in India and what are we expecting in India, and how it is not all stars and positives. We have to understand that there is a lot of intricacy that is also involved in such a scenario. So when we talk about especially Indian markets, they have reacted positively in past also, and at present also we get to see. I'll show you an example. In the case where US assets are giving low returns, as I've explained, the investors would directly move towards high growing economies, and in this scenario India seems to be fitting well, and this will help India's equities market because there will be more liquidity inflow, more foreign capital would be invested here. That will lead to increase in the trading volume that we are seeing in the equity market. Furthermore, in the very same market, we will find there is more valuation support. For example, that means the global money has become cheaper. This lifts the appetite. That means people are more interested in investing, especially for emerging market. And again, there will be a lot of valuation support wherever the investment, let's just say there is a company A in our Indian economy and it is part of the equity market. If that company gets investment, it will also get valuation support. So when we see this effect and rate cut comes in, we get to assume that this is something that will happen for Indian economy, and it has had. For example, if we talk about 2019 cut, Sensex had hit a record high the very next day. If we talk about today itself, when yesterday the Fed rate cut was announced, we have seen that Sensex has shown positive sentiment, Nifty has also shown positive sentiment, but it is not just because of the Fed rate cut, it is one of the factors. Indian market in the large sense for the past 2 decades has maintained resilience, especially when we are talking about US's monetary policy, because that affects the globe in such a high and low way that we don't want to be affected, especially in terms of fluctuation. So we want to be stable and we want to be resilient. That is why US Fed rate cut has shown some effect, but this is not just one isolated point. There are multiple points which are responsible for the rise that we have seen. And this can also bring you to understand that when we see the numbers of last 2 decades, whenever there has been change in the Fed Reserve cycle, the change or effect in the Indian market has been a little limited as compared to the global economy. This is because of the simple reason. If we are talking about the positives that come out of the Fed rate cut से जो हम advantages expect करते हैं, उसके साथ कुछ complicated और काफ़ी intricate disadvantages भी हैं जिन्हें हमें manage करना ज़रूरी है, और वो हमारे लिए fluctuations भी create करते हैं और साथ ही problems भी create करते हैं economy में. That is why now we will be moving to understand that why does Fed rate cut is a good news, but how does it affect our balance of payment, or how does it affect our external sector in the broad terms itself. Now when we are talking about the history, how Fed rate cuts have affected, I have just shown you the data. It also tells us the fact that there is a very strong short-term correlation between the FPI inflow that we see and the Fed Reserve rate cut that happened. But in the long term, if we talk about India's market performance has not been dependent on US policy. It has been very much marked with GDP growth, corporate earnings and the reforms that take in the country. And a very good example of this is the 2008 crisis that US saw, where it affected one of the biggest economies and that effect trickled down across the globe. But India showed huge resilience during that time as well. So if you see the given timeline here, especially when we are talking about the timeline between 2007 to 2015, you will find that the effect here was limited in terms of Indian market because of US Fed Reserve's action. So in this context, we have simply established, यहाँ पे मैं clarify कर देती हूँ, short term, yes, there is a correlation, but long term, India is on its own. It has to be very careful in order to understand what we can take best and what we should leave out to remain as net gainers in this global scenario itself. Now let us move ahead and understand that why we are considering this as a good news. Very simple, with which we started when we were talking about global economy, that once the rate cut is at the Fed Reserve, that means there is cheaper money available globally. There is a global liquidity surge and that helps the Indian economy and Indian markets. There is increased investment, there is boost for exports and corporate earnings, and weaker US currency also facilitates our currency. It helps strengthening of our currency. But this is the broad picture that we get to see, but the detailed picture, it becomes very much important here to be understood, because this is when RBI gets the space to take or make policies, because it would directly not lead to capital risk. For example, let's just say if RBI has to make a rate cut, right? And in this scenario, we have seen that Fed Reserve has already made a rate cut, then it lessens the possibility of capital flight from India, because US is also offering lesser rates. So in this situation, any sort of easing gives RBI the space and the bandwidth to maintain, change, accommodate policy without risking the capital risk. So this is when we get to see that there are multiple intricate things which are involved. Moving to that. Now first of all, let us understand that Fed cut affects the internal economy as well as external economy, and the effects are interlinked. Starting with that how external sector is at the direct impact and RBI policy, that is the internal effect that we get to see. Starting with balance of payment channels. When we are talking about balance of payment, it has two major accounts, current account and capital account. Can you tell me in the comment section what is the difference between current account and capital account? So when we are talking about current account, we have two important components here, that is export and import of goods and services that we get to see. In this context, when the dollar is weakened and rupee strengthens, we get to see that our import bill will cost less. Yes, that's true. But because dollar is weakening and rupee is appreciating, the exports will also be hurt. Why they will be hurt? Because at this time, because of the increased strength of rupee, you will find that the price advantage that we used to have will be lost. For example, if $1 is of 75 rupees and the rupee strengthens and it becomes 65, that means you will get less of the same good in the given dollar. The exports will be hurt. That means even if there is a possibility that import bill will come down because the dollar has weakened, the exports might be hampered, and it can also lead to an import surge that will be seen, because now dollar is cheaper for us, we would want to buy more. So this cannot be seen in a vacuum. This can actually lead to widening of our current account deficit. When we are talking about capital account, yes, as we just discussed, that it might lead to more foreign investment, specifically FPIs, but we get to see that effect usually in the short term itself, where the FPIs are coming, there is ease of external debt also seen in the economy, but all of this softening that we get to see is diluted by the second item in the list, that is oil. When we are talking about weakened dollar in this scenario, what happens is that we see that the global oil demand rises. In this scenario, it fuels the prices as well of the oil. So this will also increase our import bill. because if crude prices increase, we still have 85% of dependency in terms of crude oil, more than 45% on dependence in terms of natural gas. That means higher crude costs can easily offset any sort of gain that we are expecting from here, and this calls in for proper balance of payment management. We cannot be happy about the short-term picture. Long-term addressal is absolutely required. When we are talking about that Fed rate cut will bring in capital inflow, there are outflow risks as well. When we are talking about outflow risk, we have to understand that there has been clear evidence then FPI and gross inflow that happens in our country, it is very much dependent not just on the Fed rate cut, but the interest differentials that exist between two countries, the growth gap that still lies between two countries, and VIX and term premia as well. So any sudden risk of episode that happens in our country can easily lead to flight of capital even in a cycle where Fed rate cuts is easing out. Furthermore, RBI also, as I said, has the bandwidth to manage or accommodate its own policies in such situation. It has multiple tools like sterilization, it has options where it can use open market operation, market stabilization scheme to basically absorb the excess liquidity that has come into the market and also manage the foreign exchange interventions. But at the same time, there are multiple things, especially when we are talking about at the level of RBI, that what becomes complicated is the trilogy. What is the trilogy? I am talking about maintaining a proper exchange rate, stable exchange rate. Then we are talking about monetary autonomy and also making sure that there is growth. The balance between this trilogy is very difficult to maintain, and this trilemma also becomes more difficult to practice in the real scenario. Furthermore, there are macroprudential factors as well, because when we are talking about eased policy by Fed Reserve, we get to see that external commercial borrowing also becomes easier for India. RBI also adjusts ECB limits, external commercial borrowing limits. Then we have LRS, that is liberalized remittance scheme. The ceiling that has fixed, can you tell me in the comment section what is the ceiling at present when we are talking about remittance which can be sent? So in that scenario, remittance has also to be revised, and if there are any sort of caps that need to be put on by RBI so that currency and maturity risks are managed. This all plays in the background where we have just one simple thing, that Fed Reserve cut, it's going to help FPI. There are multiple situations, multiple backhanded factors are already in play. I hope you got some clarity in that. That was all from my side. Thank you so much.